All right, happy Friday, everybody, and welcome to our monthly jobs report readout, an economic deep dive with Professor Reilly White of the University of New Mexico. Dr. White is an associate professor of finance. Actually, are you still a associate professor of finance?
I am still an associate professor. Now I just have an additional title.
Gotcha. Okay, he's an associate professor of finance, endowed Bank of America lecturer, and assistant dean of the business school at the University of New Mexico. In addition to teaching MBA students, Dr. White serves as the University Outreach Chair for the CFA Society of New Mexico, chair of the Cassidy CFA Scholarship, and advisor for the $3.6 million student-run University of New Mexico Regents portfolio. Prior to his career in academia, Dr. White worked as an analyst for a large Boston-based bank, where he learned a great deal about company analysis, funding, and maintaining ethical corporate leadership. He's with us. Excuse me. Wow, he's with us today to talk first about the 943,000 jobs that we added in the month of July, according to the Bureau of Labor Statistics, an encouraging figure despite the onslaught of the Delta COVID variant. He'll discuss the trends, what to watch for, and whether things are getting better. Then we'll move on to the very scalding hot real estate market. As you've noticed, no doubt, mainstream media's alarm and exodus from California has not actually occurred, and housing prices in the state continue to soar despite record highs. Dr. White will address why this is the case, what to expect in the future, how it may affect your pocketbook, and whether you can actually be able to buy a house here in the next year, hopefully. In between, we'll take your questions, comments, and thoughts. Pull up a chair, enjoy, open your favorite beverage, and enjoy. Welcome back, Dr. White.
Oh, thank you for having me, Albert. And thank you, Albert's List. As always, once a month, I know we have different people in here sometimes than others, but I'm so glad for everybody to come here today. I know it's Friday. I know it's 5 o'clock. You're hungry. You're out of work. You want something else to do, but I'm so happy that you all made it out here today. And we're going to talk about the jobs report, which was great, followed by a little bit of a housing breakdown. If you have questions, I encourage you to put it into the chat window, and I will do my best to get back to you as soon as I can. So please, without further ado, let me start this thing here. And because, as I found, due to the novelty, there we go. A little bit of a delay on my end. Due to the novelty of my ridiculously shaped screen, I will keep it in presentation format. Not in presentation format, I'll keep it in slide view, only because for some reason it just appears bigger on your screen. So hopefully it will be more visible. So let's talk a little bit about the July 2021 jobs report and housing breakdown. A housing breakdown, is it a type of dance? Maybe, we'll get and figure that out. So anyway, here's what we got. Now that's a jobs report. That's my motto for this jobs report. We have 943,000 new jobs that exceeded consensus by about 100,000. And the consensus was actually notable in the sense that all of us finance and economics people like to make predictions about what the job market will be, and we're often wrong. Usually we have an idea in mind of what the figure should be, and then there's some standard. There's a lot of clustering. We all like to cluster in the same area. What made this unique is in a poll of accredited economists, the new jobs that economists were estimating ranged from 300,000 to 1.3 million. So we are on the high end of that projection. And actually, this is an incredible figure. But also to that note, we talked about how last month we had a little blip where unemployment actually increased by 0.1%. Unemployment fell 0.5, a half of percent, from 5.9 to 5.4%. This is good and very, very strong. Now, where did we see the employment gains? We saw them mainly in leisure and hospitality, which lost the most jobs. Then we saw specifically in leisure and hospitality, we saw a whole bunch more in restaurants as well, local government education, and professional and technical services. Very interesting for you all who are working and seeking jobs in Silicon Valley. Professional and technical services, we saw 40,000 new jobs last month. That's 120,000 above where we were pre-pandemic in February 2020. Isn't that good news? Now, average hourly earnings on the other end, we had a breakdown on inflation last month. Earnings are rising at about the same clip as it was before. When wages rise about 11 cents in a month, you can extrapolate that a bit more than $1 per year, a bit more than $1.30 per year at this rate. We turn that into a percentage. It's about 4% or so. That annualized, that wage growth is not enough, kind of into what we were talking about before, to indicate long sustained inflation that you might have as well. Oh my gosh, this is great. We had one response here, one open question. I think that all of those 43,000 belong to my specific company. I know, because your requisition load feels like it. That's absolutely true. You may work at that exact single company. Maybe everyone else is laying off, but with the exception of our user here today, FNinet. Thank you so much. I love that. You're right. It doesn't seem like a particularly huge number in aggregate, but I really like that we're still cruising above where we were in February 2020. Now, yes. Oh yes, there we go. I answered the question live. This is fun. I'm sorry. It's my first time operating in this professional sort of webinar format. I appreciate you asking the Q&A. So you can also put your questions and answers into the Q&A and I'll do my best to answer them. How neat with the Zoom update. Long-term unemployed. And this is one concern that we had, was the amount of people who lost their jobs and could not find other work. This happens often in recessions. And this occurs because what happens in a recession is the tendency is for parts of the job market who innovations that have been happening over a long period of time in the job market, from automation all the way down to certain jobs going away and new jobs being created. During a recession, companies are forced to make these decisions in a very short amount of time. And consequently, what happens is we end up in a situation where labor force innovation accelerates in times of macroeconomic stress. And so one concern we have is, are people being educated for other jobs in the system if their job no longer exists? Are people going out and are they able to find new work? And so far we are seeing decreases. Long-term unemployment fell about 500,000 people. That is a huge chunk of that amount. And so overall, this is good. Now, there is also a cause of concern, because I know we've been talking about labor force participation over the last few months. And we've asked ourselves, is this something that, are we seeing more jobs, more people back to work? Is this because labor force participation is going up? And it's not. People who are already looking for a job are finding jobs. The percentage of the workforce that is actually participating, AKA they have a job or they're looking for a job, relative to the working age population, is still about 61.7%. This is low. I expect, and the hope will be, and this will highly depend on what happens with different COVID variants, closing mechanisms, things that could or could not happen in school systems, not only just across California, but across the country. And so when we look at these things, we're looking at this and saying, labor force participation, we expect that as the need for childcare and elder care decreases, this means that more people could be freed up. We knew that the recession particularly hit working women. It particularly hit people involved in the service sector, and especially people who have responsibilities with childcare and elder care. And so as the sort of economy continues to grow, what we expect is, if schools remain open, if all these places remain open and childcare isn't needed as much, we're going to see perhaps a hopeful surge of people looking for work. What does that mean? Well, it depends. Those people might be able to find jobs immediately, and if not, you may see a temporary increase in that unemployment rate in September and October. Those are the 2 months I'm really, really interested in. Now, when we think about the sector breakdown here, where is this happening? And as you can see, this is you can tell by the font and the sort of unique baby blue color scheme that I got this from the New York Times. But I really liked how this demonstrates, when we put it to scale, just how vast the unemployment losses were last year and how far we've come. So we have 900,000 new jobs, and you can see our progress is not even between different sectors. Obviously, the elephant in the room is leisure and hospitality, healthcare, tourism. I'm sorry, it was hit so hard. We are still down about 1.7 million jobs across the country in this sector from where we were before the pandemic. And then if we look at other things, we have seen the surge of the last 2 months. We're seeing a lot of state and local governments going back to hiring. This is promising. We knew that the end of the fiscal year was June 30th. A lot of states and local governments had more money than they had previously budgeted for. They began hiring processes. This hopefully will continue as those projections go forward into fiscal year 2022. June 30th is the end of the fiscal year for a lot of different communities and towns. And so that's one good thing we see in this market. Now, education and health is going up. Business and professional services, a wide-ranging series of occupations that is increasing steadily, but notice we're still following. It's like it's reaching a limit. It's leveling off. We're not going to reach our pre-pandemic levels anytime within the next 6 months. But our hope is that this will be soon. Construction has been interesting. We thought construction would bounce back a little bit more than this. Certainly there's a lot of activity in building as we talk about real estate, but so far it's not overall stellar. So overall, so we have a long way to go, but we've come a long way already. If we had 6 more job reports like this one that we just had, we would cross our aggregate barrier. But again, it's uneven. Certain sectors have lost jobs, and some of those sectors are struggling to regain them back to the same levels, back to where they were before. So we will see what happens. There's a lot of open space here, a lot of avenues for us to increase. And it looks like a question from Albert's list. And it looks like professional services has already gone back to pre-COVID. Indeed, if we think about professional services as a subsector, they are unique. Not only are they pre-COVID, they are exceeding where we were prior to the COVID pandemic. And so this is really interesting. And it's good to see that, right? We see lights come on in different sectors of places where people have had more jobs than there were before. And each time we have sectors cross over that threshold and reach into a point, it feels a little bit like a victory, and that's a good thing. Now, when we think about this, what happens now? So the big question is the Federal Reserve has come out and they basically said, before we embark upon any monetary policy changes, including quantitative easing, they're going to wait for a couple of strong job reports. As it turns out, we've just had a couple of strong job reports. So I want you all to keep an eye on this particular situation. So, so to give you kind of a background in this, the Federal Reserve policy has been sort of patiently waiting strong several consecutive months of strong growth. And this is the, Albert's right, this is the money printer still going brr. Is this still happening? And give you a sense of this, what would that look like? Now, Jerome Powell's already come out and said, listen, the Federal Reserve, as you know, or may not know, what they do is they set one, they have to do a lot of things, but they set one rate, and that's overnight lending to large banks. That's called the discount rate. And they've expressed the idea that in a couple years, actually 2023, early 2023 maybe, they would consider increasing the discount rate. And when they increase interest rates, that reduces inflation, but it also puts a cap on economic growth. And so a lot of how the markets have been moving, a lot of how people have been perceiving this success is based on when the Federal Reserve will make these moves. The Federal Reserve also does other things. Now, the Federal Reserve, the Federal Open Market Committee, the FOMC, they actually might start slowing asset purchases. Now, what does this mean? Right now, to keep liquidity in the market, meaning to ensure that there's enough buyers and sellers out there to do stuff, the Federal Reserve has been buying about $80 billion of US Treasury assets and per month. And then they've been buying about 40 billion of mortgage-backed securities per month. Now, I know what you're thinking, Reilly, this is finance. Is the government buying large amounts of mortgage-backed securities? And I go, yes, they are. But here's the thing. So the question is here's how this works. How do they pay for this? Is this something, the Federal Reserve is an independent institution. We know that, the president can appoint and, you vote on the Federal Reserve chair, but it's an independent institution. Independent Fed is a kind of a hallmark of a well-run, developed country. Now, when the Fed purchases securities from a financial institution like mortgage-backed securities, what it does is it adds a credit to the bank's reserve in the same amount. Now, banks are required to keep certain levels of reserve, certain levels of capital that they can't lend out to do things with. And when the bank gives credits to these banks to do so, what this does is it enables or frees up money for these banks to start going out and saying lending and giving money to, not giving money, like it's not like it's raining dollar bills everywhere we go. They're not going to be giving money, but they're going to be, it's like one of those cash, one of those cash vacuums, right? But they're not giving money, but they're going to be lending more of it. And that encourages economic growth and economic development. So they've been doing this. So it's been keeping markets liquid. It's been keeping all the bankers happy. Bankers have been giving lots of money, sunshine, rainbows, pats on the back. It's all that's how it's been working. Now, I know you're thinking, because I bet you are thinking this. All right, Reilly. So the Fed's buying all of these assets. Isn't the second half of your presentation called Why Housing is Expensive? Does the Fed buying mortgage-backed securities distort normal market operations, like free market operations, right? Does it drive up prices for things that might already be expensive? And the answer to that is yes, no, and possibly. And so the short answer is yes, kind of. The problem is that these numbers, as big as they are, still dwarf the overall size of the real estate number, but they absolutely do encourage this sort of thing. The Fed is under a great deal of pressure to ease off of some of these markets, but they've been maintaining them because there is a fear that if they get rid of any portion of quantitative easing, the economy could easily sink or produce a disappointing series of growth. And so it becomes a really interesting question. At what point do you turn the money printer off, or at least ease the money printer down a bit so it doesn't increase any further? To give a sense of how the Fed has been active in this, quantitative easing of this manner, of this increasing the balance sheet, is still controversial. Both among the public as a whole and among economists. If we go back to the 2008-2009 Great Recession, back then the Federal Reserve had about $1 trillion of assets under its balance sheet. And we embarked upon, as a country in 2009, a series of stimuli, quantitative easing in the early portion of it, that doubled the size of the balance sheet. I remember these days when it was like, oh my gosh, the Federal Reserve has a $2 trillion balance sheet. Oh, by the way, this is in millions, and this is 2 million, which is 2 trillion. So so this is basically, think of this as 2 trillion, 4 trillion, 6 trillion, 8 trillion. So back in 2009, it was, oh my gosh, the balance sheet is at 2 trillion. And they thought eventually, the Fed would get rid of this on the balance sheet by selling their goods on the balance sheet back to private parties. And that happened, that started happening in 2018 and 2019 after more series of quantitative easing. But then we had, of course, the pandemic. And the Fed embarked upon this en masse. They since have about $8 trillion of assets on their balance sheet right now, $8 trillion, almost half of our annual GDP as a country, much of which are these financial assets. And so the Fed is sort of sitting on this and saying, you can't just wake up tomorrow and say, guess what? There's going to be an asset sale down at the Fed, and everyone's going to go off and I'm going to get all these mortgage-backed securities and do these things, because that would have a terrible effect on the market and sort of take the bottom out from the market. And so the optimal case is that the Fed ceases or reduces buying additional assets and then starts gradually, when it feels comfortable, gradually getting rid of them as the future holds. Now, you're looking at this and saying, is there a limit to the amount of assets the Fed can maintain on the balance sheet? There is not. You can have an infinite limit on this side. You are bounded by the lower bound of 0, but the upper bound has no bound. But it does create some distortions in the marketplace. If liquidity isn't needed, it can produce some frothy market operations around certain things. They've been careful around these issues, but perhaps they're going to be dealing with this in the next few months as to what and to what extent they ease off the buying of these securities. Because again, you can just look up quantitative easing and asset markets or real estate to realize that the Fed's repurchasing of things like mortgage-backed securities might be putting an artificial increase in demand in there, more than the market would otherwise indicate, which would mean that perhaps this is continually driving real estate prices upward. And so that's kind of where we are. Now, Let's break it down. So that was my 2-second pre-breakdown breakdown. Now let's go back to the Bay Area for a second, and let's go. I know this is hard to read, especially if you're in the cheap seats, and as we stream from hundreds and hundreds of miles away, what can we see? So in this particular thing, one of the things, so as we know, local data is a little bit delayed from national data. I was particularly curious about what the Bay Area data would look like for June 2021. To give you context across the country, we had a good unemployment report, but we also had a slight increase in overall unemployment across the country. And what happened in the Bay Area? We actually saw a larger increase in unemployment rate. These are, P stands for preliminary. Often these will get revised in the future, but they give you a good perspective on it. On the unemployment rate in the Bay Area rose from 5.5 to 6%. And before you sit down and go, wow, I knew it, the naysayers about the Bay Area were correct, I want to step back for a second and say, no. Actually, in June, if we look at these values here, the size of the labor force increased to the highest level that we've seen in 2021, okay? The number of people in the size of labor force, meaning people that are out there looking for jobs, are increasing. The people who are both employment and unemployment rose. To be counted as part of the unemployment rate, you have to be considered part of the labor force. People who had left the labor force were starting to rejoin it again. And they were rejoining Albert's list. And Albert, you did it. That's right. That's right. Did people jump back in? Yes, we saw the first signs people jump back in. Because if we actually look at this and we go down here and say, well, I'm not convinced per se, go down for each individual sector in this report, you'll find that each of these increased above their from May to June, with the exception of education and health services. As well as government was almost flat. Government lost 3. So except for those 2 sectors, all the other sectors increased employment. A particularly sizable jump in information. Information, about 3,000, 2,900, 2,800 additional jobs were added between May and June in the information sector. That is good news for Silicon Valley and good news for the Bay Area. Other services, that's a good question. So what do you mean, Reilly? What do we mean? And so let's give you some examples here. Maybe I can give you some more resolution on other services from BLS. So let's see here. They're not provided for anything else. Let me see if I can grab some here. Let's see. I'm going to grab some more specific information. So we're going to be looking at things, and this is actually a catch-all term, other services, for all kinds of things that don't fit really neatly in other places. So for instance, and particularly think, and actually this is really relevant if you're taking part-time work to say and run up for the recall election or something like this, advocacy, this sort of thing, promoting death care services, pet care services, parking services, religious services. All of this counts as other services. And you might see a run up in this sector a little bit. And again, I'm glad that you noted that, because I believe, or I suspect, some of that will be tied into forthcoming election related employment. So we'll see. We'll keep an eye on this number particularly. I would expect that number will increase a little bit higher in the coming weeks. Not all of it, but some of it will be. I know it's early, but people are out there campaigning. So one of the things, and that brings us another question. We're going to talk, well, that's a really good question, but we're going to talk about a couple of things that are going right now in real estate and things that are relevant. And let's, well, let me ask you this. Before I jump into housing, does anybody have any questions about anything for the first half of the presentation before we talk a little bit about housing? No such thing as a dumb question, only dumb answers, which often I also give, or incomplete ones. Oh, good. So there's a question. Albert's like, would you say that our market is doing well then? The intonation was my own. Is the market doing well? So in this particular case, so the market. So are we talking about the job market? The job market is doing well. I have concerns, and I'm concerned about and not just the categories that are listed here. Like I've always been a little concerned about manufacturing. I'm a little bit concerned about construction jobs. Where are they going? What happened to them? Especially considering that we've seen supply increases in builders starting to ramp up building houses for the purpose of increasing historically low supply. And I'm a little bit, my worry is the rates of acceleration in these sectors are vastly different. And some of them, the proportion of jobs that will not be coming back to the market, will not be coming back in total, has yet to be seen. The proportion of jobs that were lost that were not directly replaceable are estimated to be between about 20 and 33% of all the jobs that we lost. That's a huge number. Hypothetically, and not being completely Malthusian about it, I think we are going to make up those jobs in other places. So this is really interesting. And this is a good question. Are women coming back? That's a really good question. So right now, and this is the hardest part about looking at unemployment data, we know who's part of the labor force and we know who's not part of the labor force. We can extrapolate on certain levels what certain things are. Let me look up one thing real quick. Certain demographic data. So we know that for instance, when the unemployment data was released today, we knew that unemployment dropped almost across different demographic parts, right? So adult men fell to 5.4, adult women actually have a better unemployment rate of 5.0. But again, and again, the note on this is that if you aren't physically looking for a job, you aren't counted in that. And so we don't really know what the true unemployment rate is, because we aren't counting them as part of the workforce, and they might have dropped out or for reasons that are related to the pandemic precisely. We saw positive growth in the job rates across certain sectors. Oh my gosh, this is a good question. So Fontella asks, and I will answer this live. What sector would you recommend women target driven the jobs report? This is a really good question. So when we think about this in general, always target, of course, when we think about sectors, and I'm a huge proponent of this, target what you think you can, I'm going to put it this way, target what you think you can do. It doesn't matter. And I was talking to somebody actually from an investment bank that an old former colleague, and she points out she finds it very hard to get women to apply for these jobs because they often look at the application sheet and they say, I don't have every single one of these qualifications, apply anyway. So my first thing is apply for those jobs, apply for those manager roles, apply anywhere across the sector. Now, the reason that this recession has been called the she session, or the session that affected women, was that unlike in the 2008 financial crisis, which hit the financial sector, unfortunately overwhelmingly dominated by men at that time, and still today, but lesser so, and they lost the most jobs. This recession hit leisure and hospitality, service sector work, including management, all the way down to people who are doing hourly non-supervisory staff. We're seeing the biggest growth still here in hospitality, in restaurants, in other forms of management. And I want you to, when we think about anybody applying for different sectors, it looks hard right now to apply for things like manufacturing or construction jobs. But at the same time, just because they have fewer openings, because they have fewer aggregate openings. But I also want to note on this, don't feel discouraged about still applying for those jobs, because you are, as an individual, might represent the best possible candidate they could imagine. So I would encourage you to apply, or women in general, or even anyone in general, to apply across sectors, across places, looking into places where there's growth, looking at the sectors that are still growing the fastest. It's leisure and hospitality, number one, it's state and local government, and it's education. Those three things are coming back really quickly. So take a look at those jobs. You'll find the most applications there, and also some of the tightest labor markets, meaning that as a job searching employee, you will have the most bargaining power when you embark upon looking for those jobs. And so I would absolutely encourage you to do that. I love it. These are great questions. You guys ask great questions. So these sectors that are growing fast indicate that they're hiring a lot of people, and they need a lot of people, and you yourself have bargaining power as an individual employee. and never hesitate. Don't sell yourself short. Exactly. So $1,500 bonuses. He's right, from Burger King. So are these houses affordable, or are the houses really interests? That's a good question. Let's talk about the housing story. And the housing story, I tried to make something. I'm like, oh, I'll be clever and use housing terminology. I have never built a house. As obviously one of those things, just from a long line of nerds. But the housing story, the foundation, always crumbling. I'm going to go into the sources of what caused the pandemic, how we got to this point where we are now, and then where we're going to go from here, and kind of give you a sense of 3 optimistic and quasi-pessimistic scenarios that might happen. And we're going to go down to the Bay Area and look a little bit closer about some of these values that we've seen locally. So the housing story. So anyway, so you know the basics of the story, how you create rapid appreciation in housing. You need a few ingredients first. The first ingredient is historically low interest rates. Historically low interest rates. Now we know the mortgage rate tracks really evenly. So when we think about 30-year fixed mortgage rates in the United States, this tracks really closely to something called the 10-year Treasury bond. So the 10-year Treasury bond is a 10-year debt security the government issues. So when the government wants to raise money, when it spends more money than it has, which is every year for the last 25 years, except for that, the last time we had real budget surplus was in the 90s. And so to pay for itself, the government goes out to the financial markets and they issue bonds. And bonds are these debt instruments that offer you, and you probably own them if you have a 401k, something like this. But bonds are a debt instrument issued typically by governments or corporations. You become the banker. You give the company some money, and in exchange, you get an annual coupon payment, an annual interest rate. And that stuff, and that provides a stream of income for you. And then that gets taxed at the capital gains rate. And there's all this other stuff that you can do with it. So when you think about a housing story, the foundation of this was that 10-year bonds, in following the rest of the rates in the market, fell. That meant that 30-year fixed mortgages fell drastically as well. And even prior to the pandemic, they were, for at least a few years, approaching all-time lows. During the pandemic, they hit all-time ever lows. And when interest rates are cheap, that drastically increases your bargaining power. And the drop is so significant as interest rates drop from even 3 to 2 or 1%. Those interest rates, and especially for mortgages, I bought a house here last December. It's 2.5% mortgage rates, and I'm saying it because it's so unbelievable. It was unbelievable. It's unfathomable to have a 2 or 3% mortgage 20 years ago, and it's still. And then it went lower still. These rates power asset prices. It makes big assets more affordable, which then makes things, and that gives everything from residential real estate to commercial real estate. Any project where people need to borrow money becomes affordable. And low yields also encouraged two particular types of buyers that entered this en masse during the pandemic. One was institutional investors. Now we know institutional investors, what happens there's a whole bunch of places that manage people's money. They might be a pension system like CalPERS. They might be a fund, a hedge fund. They might be something else. It is a struggle for large asset managers to find yield or earnings on returns. It's really hard. They can't just put it all in the stock market, because if they did that, they'd be prone to a lot of risk. And one of the big fears about investing anywhere is what happens when there's a drawdown. What happens when the market falls and you suddenly are in a pit and you have to dig your way out of this. And this is right too. And Albert points out, back in 1989, it was reasonable. In the 80s, you could double-digit interest rates on mortgages in the 80s were super common. And that also was why, relative to prices, real estate was relatively cheap relative to today. Back then, it's almost unfathomable to think of that. If interest rates went up to 13% tomorrow, real estate prices would crash. Lower interest rates fuel higher prices, because for an average person, actually for anybody, that means you can afford more house. That drives up competition. That drives up prices. Now, that exists. So then you have institutional investors who are coming in for investment properties, looking for yields, looking to capitalize on market gains. And they've been entering a lot of the same markets that vacation home buyers have been entering as well. So vacation home buyers, let's say, and this is, I know a lot of you, this sounds like this, you guys are like, I just want this job and I got to get this thing. It'd be nice to have one house. Why would I can't imagine having more than one house. But if you have a second house or a third house or a 25th house, or maybe you're sitting out here in your 35th house, no hate. I mean, this is fun. This is finance. This is fun. And you're a 35th house and just want to know how it works. So vacation home buyers looking for a second home find it very possible to get a second home when rates are very low. So across the West, from Santa Fe to Coeur d'Alene to all of the resort communities in Colorado and all over the place, we saw vast increases in real estate prices because people were buying second homes and investors were buying homes. So all this happened. Now that in itself, as substantial as it is, isn't enough to create this sort of frothy real estate market. We had some other things that happened as well, because we had most of those conditions prior to the pandemic. So what happened during the pandemic that has made this go from ridiculous to redonkulous? The framing of the house. The pandemic caused vast market changes. So National Bureau of Economic Research estimated that roughly 37% of jobs could be done from home. The calculus for why people live in place A and place B, decades of urban planning and urban economics literature, suddenly are turned on its side because people now are looking at, I have a choice of urban amenities, and looking around and saying, these museums are closed, these other places are closed. Maybe it's time to move out to the suburbs if I don't have to commute every day. I just want more space, as it points out, as Albert points out too. I want more space. I want to live in a place that has that sort of quote unquote American dream of a single family house operating on a single family lot somewhere, somewhere like Atherton, but more affordable. And trillions of dollars of stimulus money also propelled this forward. And so we had a situation where we're looking at a pandemic affected job market, lower interest rates, financing assets, and now people want to live at home more often. So, okay, that's part of it. Now, what else happened? So let's think about the finishing touch to this. We had across the market in different sectors, a demand shock and a supply shock. And both of those things are bad individually. Put together, it's terrible. Demand increased for housing when people wanted to buy homes. At the same time, the supply of homes, the amount of homes people were willing to put up for sale, as well as the amount of homes that were being built, decreased. And when that happened, supply went whoop, and demand went whoop. What happens is, I don't have to draw an economics chart to show you, that increases the fair price of it, and it's drastic. Inventories for homes available for sale reached the lowest we've ever seen on record. Like literally the month supply of housing in the United States dropped to the lowest levels. We saw community after community, county and state report that the fewest houses for sale that they've seen were happening. Meanwhile, we have builders who normally would come in and be like, well, it's time to build in this. They delayed new home construction due to excessive materials costs that we talked about in the inflation breakdown last time. So things like steel and lumber hit sky high because everyone started demanding it at the same time. They delay construction. That prolongs the ability for the market to correct itself. Second home purchasers are out there fueling markets and vacation communities, as well as places like this. Maybe you know someone that's like, I'm a second home, I'm going to put it in Fremont. Credit worthiness of buyers is significantly better in this market. And I want to note that importantly, because back in 2008, people always look at, they always kind of go through the same sort of past glasses, looking past glasses. That's not even a term. It's like rose-colored glasses, inverse rose-colored glasses that show you the past. Anyway, if we went back in time to 2008, creditworthiness of buyers was much worse. Banks were pumping mortgages to people that didn't need mortgages, shouldn't have mortgages, driving up prices, and with non-creditworthy borrowers, and that helped take the bottom out of the housing market. And so when people think about housing prices going up, their first thought is, will they go down the same way? And it's not there right now. The credit worthiness of buyers is almost 50. The credit scores are on average for the lowest 10th percentile, 50 points better than they were previously. And that's fascinating. And that really is fascinating. Oh, well, this is like a question for Albert. Albert, are there recordings for the seminar, and where can people like Pratik view them? I'll leave that one for Albert. So what we got, we have low supply. YouTube. YouTube, MyTube, we all tube. 10-year forecast as of March 2018. The purpose of this chart is to show you that the expectations for people managing large amounts of money, the returns they expect to get because interest rates are supposed to be low and basically continue to be low for a long time, are going lower and lower. What that means is that investors are looking for more creative ways to generate income. And some of that has different forms, like we've seen an explosion of private equity in the last decade and a half. We've seen people put money into things they might not otherwise put into money. Investors are seriously looking at real estate more because it offers a higher return than, say, bonds might, and a lower return than stocks. So we have all of these macroeconomic factors. And then let's go down a little bit and kind of gauge the level of these supply issues. The average home, and this is from Redfin. If you go to Redfin's website, one cool part about this, they employ their own economists and their own economics team, and they have updates and data. Check under Redfin's news. I like the stuff that they do. So the typical home, on using Redfin data, because it's real time and they have access to all of these transactional data that's happening across the country. The average time a home is spending on the market is 16 days right now. 16 days. Look at this chart on the top. Back in 2019, it was common. The average time in winter, they lasted about 60 days. In summer, a little bit under 40 days. Houses are flying off the shelves. 36% of them are going under contract within 1 week, 50% within 2 weeks. New listings of homes are decreasing. And this is given as, let me put it this way. So we saw a moderate, let me put it this way, a substantial even increase in housing supply across some markets as we approach the most recent data in mid-2021. Now, what happens now is that new listings of homes follow a very seasonal pattern. They're expected to, and they're kind of turning the corner. There are fewer homes being listed because we're entering autumn, we're getting closer to winter, and usually at the end of summer, the physical number of listings starts going down. This is a observed seasonal phenomena. Now, houses are still selling, and you're looking at this saying, are we seeing evidence that the high prices you're seeing offered for homes, when you drive by a house and you say, there's no way that can possibly go for that amount of money, is it possible that they have overshot the hopes of the market? The average house is still selling for 102% of what the listing price of the house was. And this is right. Albert says people have found school districts for their children, so the hot market will cool. I like the finality of that statement. We found school districts and things are great. And then that's what it is. I love it. So let's think about this. Is this going to ease? And let's talk about this. So here are some signs that it might. Mortgage purchase applications, lowest level since May 2020. The amount of people looking for homes is declining. Why aren't they looking for homes? I know. As Albert points out, a 2,000-foot lot in San Francisco for $3 million. Yay! That's great. Just think, is it worth it? That's a great question. I seriously wish I was wrecked fondly. I don't know. I wish, years ago, I wish like my grandmother, she lived her whole life in San Francisco and Richmond, out of Richmond. And like even that little house, that little tiny house that she raised 6 or 7 kids in, now it's in the millions how much it's worth. So close, but so far away from actual wealth generation. So anyway, I hear your pain. So it's really interesting. So mortgage purchase applications have gone down. People are turned off because prices are so high. Home prices decreased slightly. And here's the good news. After a 5-month run where we've seen nothing but growth in home prices across the country. And I know this is average for the country, and I'll zoom in for the cheap seats. I know this is almost laughable, right? Where are you going to find a $300,000 home? Is this real? I don't believe it. Just bear with me here. We'll go down to the Bay Area in a second. So in 2019, across the country, the average home sold for about $275 in May of 2019. That increased into the low 300s in 2020, a sizable increase. But then in 2021, to have those values up to 363,000, this is the fastest we've seen real estate prices increase. It is an unsustainable value that is increasing on a year-to-year basis, right? And there is a limit to this. Even with low interest rates and affordability and good credit scores and people saving more money, all of which happened due to the pandemic, there is a limit at which the market can have because wage growth itself doesn't support this. Now, I'm going to turn that around in a couple different ways. First, I'm going to present something and I'm going to contradict it with yet more data, and then we'll synthesize it. So pending sales are also tracking lower, but this is seasonal, right? Ignore 2020 is the blue line here. That's an abnormal line. We had a pandemic in March that shut off the summer real estate market first. April and May, no one wanted to go out and buy real estate or look at houses. It was too terrifying. It recovered a little bit in summer and it recovered significantly in fall as a little delayed thing and then went back to normal. 2020, the line in red, 2021, I'm sorry, the line in red, we're looking at an almost exact seasonal pattern to pre-pandemic 2019, except the volume is more. And that's because more people are exchanging houses. And that is enough. So the problem is it's tracking along well to 2019, but unless this line starts sloping downward at a greater angle than what it's doing now, we're not going to see an alleviation of real estate prices. All right, so also, and important to note, where have we seen this? And I think this is an important observation. So one reason that the Biden administration extended rent or extended protections for people who are behind on their rent, et cetera, evictions, is that there really is sort of a situation in this country where we have a vast disparity. Now, at any given time, about 65% of American households own a home, about 2/3. It's about 50% in the city of San Francisco, a little bit lower because, as Albert points out, they're all $3 million. It's an interesting observation. And but the way that these houses are built, so for instance, a landlord looking at evictions and other things, there would be negative consequences to real estate prices and rental prices if those evictions happen, and particularly if those people couldn't find homes. Pratik, isn't saving meaningless when inflation is positive? That's a really good question. So Pratik brings up a very keen economic observation. Inflation discourages saving. It hurts savers. And so the reason this would be relevant to this discussion is exactly for that same reason. So if I was economically rational, which often we are not as human beings, and don't pretend that it's okay. Like I am not economically rational all the time. I think I just bought, it was inexpensive. I think I just bought a goblet this week and it is delightful, and I'll have to shellac it to make it drinkable. There's no logical reason why I need a goblet. Anyway, so it was inexpensive. Never spend more than you have to. So one of the aspects with, I do own Doge. I do still own Dogecoin, Albert. Thank you for pointing that out. Pratik, isn't saving meaningless when inflation is positive? Inflation erodes savings, but people with savings, and when people embarked upon savings over the short term, which again is economically rational, there's uncertainty around your job in other markets in a recession, so you save more. The savings rate in the United States, which typically is around 7%, shot up beyond 14%, and even reached the 20 to 30% level. The data gets really noisy because the people who could save were the haves and the people who could not were the have-nots. But the savings rates went up. And when saving rates go up, the logical point is what do you do with that cash? You can spend it on stuff that exists, goblets and things and iron things, and they exist for a moment in time, but they offer you no real return. or you could buy things that make money. And the biggest, and that ranges from stocks, which we saw an explosion in the stock market, to bonds, to real estate. And so rationally speaking, if you're seeking above inflation yields, going into anything that has an opportunity to beat inflation becomes rational. So saving isn't meaningless, but but from the perspective of behavior, and this is the key point, consumer behavior, it is predictive of what people will do in countering situations. And again, if you are facing high or potentially higher than normal inflation, it is optimal for you economically to start looking at where can you generate funds so you can beat these values. And that becomes the name of the game. And how accessible those are to you, how they make sense to you, vary with their certain things. Obviously, certain people, 50 years ago, 45 years ago, during the 1970s, we had high inflation, but we also had, and consequently, high interest rates that depressed property prices. It made a lot of things look like bad investments. And so there are infinitely worse markets than this one. Now, the US housing market, to give you a sense of the level of growth, in aggregate, look at that slope of that far right line. The slope of that line is as high as we've ever seen it. Looking at 17% annualized growth year on year or higher is just absurdly high. And this is from S&P and Case-Shiller values. Now, back in then, if we look at this, the midpoint on this chart is 0. So this is 0. Sometimes you make money in real estate, sometimes you don't. If you include the downsides as well as the upsides, a rational real estate return is between 4 to 5% per year. We are exceeding that to the level of 15 to 20% and sometimes more. How much have home prices dropped? Increased rather. Two sectors have powered these increases. The first one is the luxury market, which was up 26%. The second one, and you're like, oh, that makes sense. People are buying those second homes and those fancy homes, and luxury, of course, is relative. Basically, every home in the Bay Area above a certain level, because it's so expensive, falls under that luxury category. These are divided into quintiles, so it's the top 20% of real estate in the country. But the most affordable real estate, the real estate on the bottom end, has also shot up as well. And so we're seeing increases in prices drastically at the high end and then also at the low end. Price increases have been more moderate in the middle. So let's think about this. Where are we going on this magical housing train? So first of all, delinquency rates on mortgages are still really, really low and within the bounds of what we consider acceptable. They are higher than where they were back in like mid 2005, but they were lower. Delinquency rates, which were paused by the recession in certain banks, have been going downhill since the last mortgage crisis. Forbearance data, yes, we do have mortgage and forbearance data. Let's see if I can, I did save that chart for the mortgages here, and I just got to make sure I have it as the most updated. All right, servicing value and forbearance, yada, 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 March 20th, May 10th. Get me some more recent numbers than this. I'll go find that for you. So yes, mortgages and forbearance increased. As you know, during the start of the pandemic, the forbearances became written into the stimulus packages as being a legal and reasonable way to keep families from defaulting on their mortgages. And if you're in forbearance, you actually collect these payments over and over and over again, and then you have to sort of come up with the money to pay them in mass afterwards. And it makes it a very challenging thing. And let me see if I can get some more recent data from Fred. Has some mortgage and delinquencies, but they add all the forbearance stuff into it. And I have a little bit of slightly old data, but it's from February. I'm going to get on that. Maybe I can get back to you fairly soon on that. And if we think about this, if we look at the trajectory of it, it is staying reasonable, but I need to get some historical data as well. So let me get back to you on that, Albert. I like that. That's going to be an interesting thing. So forbearances, the forbearances are a thing to watch as well, because we know that may indicate a potential. And I know this sounds almost immoral to hope, especially if you're looking to buy a house, for a decline in real estate prices based on economic conditions. It is challenging. But I want to put something into your bonnet regarding how the United States stacks up globally. So on housing prices, the United States, which is down here in green, this is kind of a hard thing. This is grabbed from some analytical house pricing data I was able to get. If we look at the trajectory of the United States prices, where in 2015 the price of the price to income ratio for a house was 100. And this is price to income, I should say. So how much house you can buy versus the income that you earn on average. In the United States, we're a little bit more, it's a little bit more costly now to buy a home than it was back in 2015. But compared to other countries, Germany, 28% higher, Canada, 25% higher, even Australia and the UK, 9% and 15% respectively. If we change the starting point of that to the year 2000, where we look at real house prices, inflation adjusted house prices starting in the year 2000. And I love this graph from The Economist, even though it doesn't include all of the growth we've seen in 2021 yet. US prices are still far below the asset price growth that we've seen across other countries. Canada, Australia, France, and Britain, for instance. We're on par basically with Ireland and to a certain extent, Germany has always kind of lagged behind in price growth since 2000. Now, the question is, what this says is you can view this two ways. One is that real estate prices are expensive everywhere, and maybe the globe is due for a asset price reckoning at some point. The other one, in the immediate term, is more relevant to us. Is it true that the United States, do we have more bandwidth to increase real estate prices as expensive as they are relative to other places? And the answer is maybe. Asset price growth, Canada and Australia, you have friends, colleagues, cousins, family, other places in different places from Vancouver to Sydney that are looking at vast increases or dealt with vast increases in real estate prices. And the question is the United States is using several objective measures cheaper than both of those countries with regards to real estate. Now, is that going to be because Canada and Australia have irrationally exuberant markets and they will go down in value? We know that there's an economic purpose behind it. Both those countries are heavy resource laden. They're commodity currencies. And so consequently, you have volatility and increased prices because of it. We also have investors. You also have conditions that are changing and evolving. And there might be more space. My point is, there's nothing to say that prices have to increase tomorrow, 1 year, or even 10 years from now. That is the situation that housing is in. So even despite this stuff, it's still uncertain whether or not housing prices can or will go down. People remember 2008 as this bubble that went down and they could buy stuff again. We don't have the fundamentals there to indicate that the housing price will crash anytime soon, unless those fundamentals change. Now, go down to the Bay Area for a second here. And I tried to zoom in. So I grabbed San Francisco and San Jose data in aggregate. And if we look at these things in their own, little sub-metropolitan areas, across the board, more houses are being sold today than they were last year. Now, we can compare that to the rest of the country, and these increases aren't as drastic as we've seen in the country, but they are there. Look at San Francisco. The most affordable homes, the bottom quintile in San Francisco homes, have increased year-to-year changes in sales 160%. Luxury, 178%. In San Jose, we see that bow pattern that we saw with the rest of the country. The cheapest and the most expensive homes are flying off the shelves. The median price changes along with them. The most affordable homes in San Francisco have actually gotten slightly cheaper in the last year, but everything else has gotten more expensive. Mid-priced and high-end real estate has grown up by 4% and 8%. And then San Jose, you're looking at 17% year-on-year increases in mid-price real estate. And Reilly, what do you mean by mid-priced? Well, in San Francisco, we know that means about 1.4 million. And then in San Jose, such a bastion of cheap real estate, that's 1.35 million. Oh, man, what a time. Is it time to move to Fresno? I don't know. One of those things. No, that's not tomorrow. $4 million on the upper end luxury real estate, top 20%. They have seen increases as well. Active listings have increased. The median days on the market across the board have gone down. In San Jose, those $1.3 million homes, those mid-priced San Jose homes, the average time they're on the market, 9 days. 9. It's not even time to look at it. I got to look at it the same day. You have to trudge through the, at 3 a.m. in the morning, just knock on doors. Hey, I'll give you 1.6 million for your house. Do you have financing? Maybe. This is the question. And so as Albert ties everything together, back to the question of the Exodus, the problem is when we look at the population, and this is, I was just talking about this because I was online with a former student who lives in San Diego, and we were talking about the California Exodus and what that means and other things. It's not at the level. If we saw a true economically significant exodus, in a certain extent, we should expect to see this in the real estate dynamics. In San Francisco, the real estate dynamics are complex, and you might argue, and I'm going to be my own devil's advocate, Reilly, isn't the lower than average growth in San Francisco indicating that there is an exodus? And the short answer to that is not from California, but to other parts of the Bay Area. So if I look at housing as a litmus test for supply and demand, and I just took, and I like using Zillow data because it's colorful and easy and fun. So I'm using Zillow and Redfin. Do they compete? Do they care? I don't know. But June 2022, the United States average house price on Zillow is about $332,000, roughly consistent with what we've seen in other places. San Francisco, the city of San Francisco, about 1.5 million, nice and cheap. Berkeley, 1.56. I added Fremont and San Jose. It's kind of like a sampling of different areas. But the point is, San Francisco prices kind of do this. Even San Francisco prices at that far end are seeing that little uptick. But look at the rates of growth. Look at the slope of the lines in Berkeley, Fremont, San Jose. Those lines match the rest of the country. People are still demanding real estate there. Prices are still going up. And prices are going to go up until they stop going up. So what's going to stop them from going up? And so there's a few things. Ooh, here's another question. This is from Pratik. Oh, this is a good question. How do I understand that it's fair price data or it's not blow up data? What's a good source of data? So Pratik asked a really good question. So when you find data, I'm glad you asked about data, Pratik. So one of the ways, the most common method that when people evaluate the price of real estate, when we think about these things or real estate as a whole, the one that we see most common, and I'm going to grab this chart really quick and I'm going to sort of paste it. We'll do some live finance to answer your question, is called the Case-Shiller Home Price Index. And what made the Case-Shiller Index cool when it came out was that it was really hard to get the data that you described prior to the Case-Shiller Index existing. And Case and Shiller, both incredibly well-known economists, devised this method where you can look at prices and compile prices from different communities in a way that provides a home price index that can be used for economic purposes. And when you think about this, in the last, and to answer this question, Pratik, the Bay Area dynamics, if you look at this as a whole, Case and Shiller represent a good representation of this. Websites like Redfin and Zillow are not used as much academically, but they're useful because they compile all of those sale data. Now, when we question, and the data itself, as far as I know, is not scrubbed in an academic sense. So obviously, you'd want to toss out, if you were doing an analytical report on this, you'd want to toss out data that seems suspect, right? So you wanted to toss out data where somebody sold their house to their favorite relative for $3 or something. And then you'd want to evaluate that and see if that altered the median of it. But I use Case-Shiller. I would actually get in the cool real-time data you get from Zillow and from Redfin. But the problem with that is that beyond what they can show you themselves, it's hard to access that data for free. apart from the graphs and other things that they have on their websites. And to access the raw data, for instance, is a little bit harder. And so the easiest way to do that would be to compile and look at records for the area that you're studying. But it's a really, really challenging thing. Facebook question, given what you just shared, would it be fair to call it an exodus? Would it be fair to call it an exodus or just people moving out of the Bay? I would say it's consistent with our old hypothesis. People are moving out of the peninsula and moving into places around other places in the Bay Area. That's what they're doing. They're moving to other Bay Area locales. So I don't see, the hard part is I don't see downward price pressure in San Jose, in Fremont, in Berkeley, and all these other places. I know you'll say, well, Reilly, what about Sunnyvale? What about Sunnyvale? And we don't, and the hard part is we don't know what precisely will ultimately indicate, or at least with the data that we have. We have moving data, other things. It's not an exodus to the economically devastating level that has been portrayed. People do move out of state, but good luck in Sunnyvale. I know. Good luck. I know. So one of those things, I know. That's the real moral of the story. Stay away from places in Silicon Valley that make that are headquarters to tech firms that make their employees go back to work. And so that might help a little bit on the peninsula side. But in short, to answer this, the aggregate data, if it was an economically devastating loss of population, we might see some of this in real estate markets. But of note, real estate is already expensive. We know that people are moving to other parts of the Bay Area. People are still in some elements leaving the state, and we had those numbers last time, and I have to update them to what they are now. But it's fair that people are moving, but the biggest onus for them moving isn't moving out of California as much as it is moving to places where their lifestyle can be better. Where would you live if you didn't have to commute? Where would you live if you could work from home? And it's just the changing of the questions that are being asked. That's a really, really good question. So is there relief on the horizon? And you've seen this around. So Senate Bills 9 and 10, right? And they're cooking around here. And I wanted to address them because on both sides, you have sort of on the NIMBY versus YIMBY side, the not in my backyard versus yes in my backyard side, you have a very heated debate, a very heated discussion about what it means to change zoning laws in a state like California, and whether or not they end up being successful or whether or not it ends up being passed. They are presenting a lot of very absolute opinions on this matter. And looking at this economically, you have to ask yourself, say, okay, so first of all, economic facts. The key point in the key challenge for California in being conscious and conscientious of environmental concerns and development patterns and development growth is to generate more housing. The greatest way to lower prices in real estate is to build more houses. You need to reduce housing scarcity. And the hard part is, in essence, more units need to be built. Now, on the other hand of this, there's a lot of very unhelpful rhetoric out there. I don't think in any way, shape, or form that rhetoric around getting rid of or abolishing single-family homes is particularly helpful. I think the idea is in certain areas, you'll see a conversion of single-family areas naturally through development into multi-family areas. But ultimately, people have a choice, should still have a choice, whether they want to live in a single family home or a multifamily dwelling. But allowing those homes to be built in areas where it's economically possible for them to be built does take off the pressure of housing. It is hard to imagine that even if the bills were sweeping, and I was reading one today, and they're interesting, and they offer some interesting perspectives on this, that they'll produce a dent in the real estate market next year. It's going to take time. It's going to take development and strange things and critique and potential rollbacks, and it's going to be a fight. But the long run the one you have to look for especially in dealing with any place where there's a scarcity of housing supply, especially affordable housing supply, other things, and an excess of demand, And that's what supports these really, really high prices, is how can you arrive and build more homes? And that's a really, really challenging question. That is a fundamentally challenging question, which leads us to our final slide. What happens from here? Scenario one. Scenario one. Ooh, good question about the bills before I get to these. From Adib. Are these bills effective against city and local ordinances? For example, Campbell's city official, the Campbell's city officials are the biggest obstacles to expanding housing, especially when a town hall meeting is put out where people are fighting against current town owners. That's a really good question. And my first reaction to this is that, of course, the reason that you do have laws like this, and this is the really, really hard part, right? And I myself live in a community which is itself limits development to preserve the existing prices of the homes that people live here. And you can call it one thing or you can call it another thing. If you live in a very expensive part and you have a house there, preserving the value of that house, you might think, oh my goodness, I'm not doing this intentionally. I'm not doing this intentionally. I just love living here. And nobody wants to see a community that they love transformed into, something that is unrecognizable to them. That's a human flaw. That's a human condition that we all have. But if you're thinking an aggregate thing like economists, homeowners vote in city officials. City officials work on behalf of the homeowners, and consequently, you have a whole swaths of Bay Area communities are covered by prohibitive local ordinances against development. And there are reasons for this. And I'm not arguing for unrestricted development. I'm not arguing. I'm not going to extend my argument out to the absolute extreme of this. But the question is, stuff is expensive because there's a scarcity of building locations, right? We know everyone knows where the mountains are. We know where the water is. And there's very few areas in between those places that allow you to build. If left naturally or without restrictions, they would evolve into multi-story complexes and things, but that hasn't happened. And consequently, building real estate equity is out of reach for many people in the Bay Area. And that's a majority of Americans build their primary source of wealth is actually the real estate that they own. And so that becomes a particularly interesting question. Now, what I don't know, you asked a very specific question, and I'm going to leave that for the people here. I don't know enough about the bills if they supersede local ordinances. And is that the case? And I've read certain things that suggest, I'm curious if anyone has heard something differently. Oh, this is a really good question. Let me check quickly. As actually a good observation from Adib as well, it puts renters in a very weird spot. For example, people who wish to rent in South Bay to be closer to work, but have little influence in South Bay because they live in East Bay where their votes are recorded. Absolutely right. So you're renting in a community, but you don't have the same voice of the community as, say, an individual property tax owner or somebody in that role. And they live in East Bay, and their votes are recorded in there. And you're trying to build up. You'd love to live in South Bay. I'm sorry. You'd love to live in South Bay, but you can't. You live in East Bay because you can't vote on this. I will argue purely from an economic point of view, without knowing the details and being an economist and not a legal person, and a finance person, not a legal person. Good zoning regulation is only effective if it does supersede local laws. That's it. And my hope is that it is written that way, but I don't know the constitutionality of it in California, and I don't know anything else. And I want you to explore this, but I want you to keep an eye on this as well. And it's important, and it is important to look at these things. Especially if you're renting and looking for, how can I even buy a condo unit in South Bay or an apartment that was, if you had a multifamily housing unit that was less expensive, how can you buy that, build equity, build wealth, and then grow and sort of go up the ladder and those sort of things? These are important questions. Now, I really appreciate you sharing that, Adib. That was awesome. So let's think, what happens from here? 3 things could happen. Number 1, oh yes, understand the repercussions. Senate Bill 9 and Senate Bill 10, Pratik. What happens from here? Scenario 1, there's a cooling trend. In other words, higher prices are met with larger housing supply. We've seen that on the builder side. The Fed gradually eases quantitative easing. Interest rates start rising slowly. The growing economy will keep prices elevated, but the growth in real estate returns to a long-term mean. Right now, this is the most likely scenario as I see it. No price decreases, but prices growth slowing down. Scenario 2, this is a little bit more of a snowball effect. What goes up stays up. The Fed doubles down on low interest rates and quantitative easing, which could be as simple as a bad jobs report next month or the month after. Market frictions around new development keep prices high. A shock in supply for certain lumber or trade goods that are or steel, something like that raises prices and forces builders to delay or potentially cancel investments. Local frictions, zoning laws, things like this are unable to keep up with demand. Even more investors in a low interest rate environment start seeking yields and expand property investments. It looks like the Euro Australia asset price growth situation, and this is interesting because obviously your critique can say, well, Reilly, the UK is very expensive because it's very dense. In Australia, which is less dense, substantially less dense than the United States, they're seeing high asset prices as well. And this is what happens in that scenario. Prices continue to go up in this situation. And to answer Albert's question, if COVID variants run amok, what happens is, and that forces the US into a situation, and this is interesting, right? So eventually, bizarrely and terrible as this next month or two is, regarding the amount of people who are vaccinated and unvaccinated and the amount of variants floating around, I'm still optimistic that we'll reach some form of herd immunity eventually, in which case new economic closures will be short lasting if they exist at all. But the fear is, if this does happen, if COVID continues to run amok, and it's a meaningful way, then it kind of, and it say encourages additional stimulus, money, other things, that does encourage a real estate market like the one we have. And the only hope is, and that has other effects, reduced construction, increased prices. The hard part is it's not going to affect jobs for the people who have the privilege and the ability to work from home. And consequently, those people will continue to make money and want to buy second homes and stuff. And that's going to be a problem. And the Fed will be incentivized in those situations to continue rates low. And so the COVID scenario is more like scenario 2. Scenario 3 is the most volatile example. We have high prices now, but eventually supply starts overcompensating. We start building more houses than there's actually demand for. Interest rates rise. Home ownership lags for younger buyers. People are still turned off to higher prices. These combination of factors could see or precede a year-on-year decline in real estate prices. That would be mild, barring a major macroeconomic shock. If a major macroeconomic shock or a recession were to happen again, then those declines would be more severe, particularly if it was a recession that was not caused by a variant. So these are the 3 outcomes. If I were to assign probabilities, I'm basically, I view it as like 70%, 20%, 10%. Scenarios 1, 2, 3. But I encourage you to make your own opinions, be critical in your own way, and figure this out for yourself as well. Oh my goodness, this is good. So I was gonna do Q&A, but look, here we got. My first question for Q&A is from Adib. He has a couple of, he has a vast and interesting question. If variants go around, wouldn't that encourage remote jobs and help reduce home prices? That's interesting. And the problem is Adib, is not that. So if you're looking at the city of San Francisco itself, sure, that would encourage people to move out of San Francisco to move to other areas. But the problem is that people have been doing that for 1.5 years. And right now we're seeing year-on-year real estate growth well into the double digits and at levels that we've never seen before. And it's because people might be leaving cities and living in the suburbs, but then they're forcing the price of those suburban homes up even higher. So that's a question that might, though, and to be specific to your question, a continued COVID variant might reduce local real estate prices specific to inner cities, where people feel the trade-off between lifestyle and cost isn't worth it. And that would be the question. And he points out what's keeping Bay Area expensive is that demand by the Bay Area tech industries and sister industries are forcing people back. That's true too. I know that is, I like, you did not mince terms there. And that is true. Many firms will do this. And I think it's interesting to see how this evolves. I suspected at the beginning of the sort of in the pandemic that companies who are able to offer at home or remote work would be more competitively positioned in this marketplace. And you do see that in some cases, but there is still this sort of a lot of traditional mindset, a lot of things where people look at work culture as being essential to bringing people back together. And it depends on a bunch of things, on the nature of the job itself and the nature of the work. So if not, is there something else in the Bay Area that attracts investors regardless of whether jobs are here or not? And what is the golden trait that makes the Bay Area attractive, if not jobs? The Bay Area is culturally significant. It is economically significant, as you point out. And it is, if you have, I know it's if you live there, it seems it's almost something that can be taken for granted, or the way the fog moves in or out, or even standing, on Mount, Tam and gazing out into the wilderness. You're kind of looking at this and saying, it is objectively a beautiful place by any human standard. And you look at this and stand apart this and look at this and say, this is why a lot of people love it. People love the climate, the beauty, they love but it also, to support this, I'm trying to think of something non-economic. Albert points out agriculture is huge, Central Valley ag is big, and other things as well. So, but there's a lot of reasons for that, why people would keep being attracted to the area. But the reason, as you point out, that the area is so robust in real estate prices, you have a small area of buildable land relative to the number of people that are there. And also the zoning laws in this small area of this buildable land are often geared towards single family homes and what we would call lower density relative to what we see in Europe and Asia. And consequently, that does drive up prices across the board. And so then you need zoning reform, other things, but then that changes the character of the city. And that has to come with a bunch of other things as well. And that's a really complex and interesting question, Adib. I'm so glad you asked it. And then another point, for context on companies attracting people back and how it drives up home prices, I work with Apple, and Apple's giving away a very high sign-on bonus, about 25 to 50K in cash, which gives the ability for those who have funds now to buy a home here, because people with a high injection of cash after a period of time, that's really good. And so firms to be attractive can encourage that. And that in turn helps keep real estate prices high for people who don't have $25,000 and $50,000 bonuses. Another question, Pratik asked, could you share some resources to learn from? Okay, I can share some of those in these things. That's really interesting. I have mainly my sources are you've seen all my sources in data and other things. Let me see if I can, what I can do is, I have all these PowerPoint slides come from different places, Redfin, other places. There's so many things. I could give you economics links, other things. Feel free to reach out to me. I'm happy to incorporate as many things as I can to provide these resources open to you. To give you a sense of the jobs report, here's a link to the jobs report itself. I'm going to send that to everyone. And I'm going to send one data that I like to get data from. I like to get it from Fred, which is here. Oh, yes, I published. Yeah, Albert says, Albert's asking, what about a paper I authored and published? About what, though? I have cryptocurrency papers and other things. I can't give you, I can give you that. You can look it up on my CV. Some of these might be behind paywalls, but if you find an interesting paper, I'd be happy to send it to you. I have about 16 peer-reviewed articles in the last 7 years or so, and they're from a variety of subjects. I've written on cryptocurrency, I've written on corporate finance, I've written on pensions. Most of those are pretty dry because that's what goes in finance. We just had one in the Journal of Banking and Finance that talks about mortgage. Actually, sure, let's do this one too. This is not, if you guys want to read something that we wrote recently, with my incredible co-author, Leslie Bonai at Cal State Monterey. Shout out to Monterey. We wrote an article here. Let me share this. And it was looking at short selling in the last financial crisis among banks and what that meant. I mean, this is dry stuff, and it's a little embarrassing for me to be like here, look, but I will happily, and I'm honored that you've asked me to share this. So let me click this here. I'll get the link. This should work. Hopefully it's not behind a paywall, but you can look at this. So stuff like this, a lot of charts, a lot of short selling, a lot of things like this, how banks work, a lot of estimation. I know we have a very technical crowd, and I'm sure I'll get critique about my empirical methodology, and that's totally cool. And that's what makes science go up, and that's what makes science work and finance work. But this was really fun. This was I took a long time to write this. That's a long story. A long time. All right, guys. Anyone else have any questions that I can answer while we're cooking with Crisco here? I have extended beyond my time. Doctor, yes, Albert. Oh my gosh, thank you, Adib. I'm so grateful for your questions. That was good. Yes, please cite me in your own academic papers. I need to boost my citation count. So yeah, I write a lot of papers nobody reads. But it's great. But that's what makes it fun.
Good times, good times. All right. Well, if there's no other questions, I want to thank you all thank you for joining us first, Dr. White. And for those of you who are listening on Facebook and on Zoom, thank you for investing some of your Friday night here into learning about where the job trends are headed. If you enjoyed this event, we'll be doing this event next month where we're going to address how these COVID variants might affect your job search and how they will have affected the economy. We covered that a little bit today, and we'll probably talk a little bit more about it next week as well. And maybe even also cover a little bit about the upcoming recall election and those impacts too. As always, it'll be on the first Friday of the month, so mark your calendars. Finally, we also have some other upcoming events of interest this month. This month, we're talking about the Great Resignation, salary negotiation, and our upcoming job search bootcamp. Take a look at our Eventbrite page that I've linked below for more information. Thank you all. Have a great weekend, and we'll talk to you next month or next week, depending on the event that we see you at next. Have a great weekend, everyone. Bye-bye.